Welcome back to another video in this specific topic section. Today we're going to have a very nice and simple risk and return video. I'm going to try to keep this as simple as possible and as quick as possible. It's very simple. It's just risk and return. You already know kind of the basics of it just by hearing the words. But yeah, so what is return? Well, return is the gain or loss you make on an investment. Easy. This is usually expressed as a percentage, sometimes as a price. It depends. It's usually a percent though. On the other hand, risk is the uncertainty that comes with that return. It's the possibility that things won't go as planned. So in investing, risk and return are obviously closely linked. The more return you hope to earn, the more risk you're usually taking. So there's a statement called high risk, high return, and we know this with stocks, bonds, crypto, and more. And if you watch the bond series, I talked about bond ratings. So if you remember, this is kind of like a bond rating is kind of like a risk and return. And so we know that the lower the bond rating, the higher the risk. That the bonds have higher yields, therefore making the statement high risk, high reward true. So as we're saying, is the lower the rating, it means higher the risk. But usually, the lower the rating, it also means the yield is higher. So higher risk also results in a higher return, making the statement true. And obviously, there's no such thing as a high return, no investment. That's usually a red flag and a scam. And obviously, if someone offers that to you, fun. And so understanding these trade-off is part of like smart investing and like management. So yeah. So there are types of investment. So not all risk is the same. And so understanding the different types can help you make smarter investment decisions. Now, first we have market risk. This is the risk that your investment will lose value due to broad economic events. These can be like interest rate hikes, geopolitical tensions, maybe even a recession, and it affects nearly all assets. Another one is credit risk, and it's mainly tied to fixed income investment like bonds. I talked about credit risk a lot in the bond series. And it's the risk that your borrower or whoever lending you money, let's say a company or government, fails to pay you back. We talked a lot about this already. Then there's inflation risk. Inflation risk, obviously, it's in the name. This happens when rising prices. This happens when rising prices reduce your purchasing power, and even if your investment growing, inflation can quietly eat it away, and actually your real return is very low. There's interest rate risk, especially relevant for bond investors, obviously. When interest rates rise, existing bonds often fall in value because newer bonds pay better rates. And then also there's liquidity risk, which refers to how easily you can convert your investment into cash without taking loss. And stocks of small companies or niche assets may be hard to sell quickly. And so all of these risks are part of an investment landscape, and managing them effectively is just as important as chasing returns. Now, so to understand whether an investment is worth it, we need to measure its return, which is the gain or loss you experience over time. So let's break it down very simply. First, we have the nominal return. This is your raw return. It is the difference between what you paid and what your investment is worth now, plus any other income it generated. This is what you typically see on a statement or even a performance chart. For example, let's say you bought $1,000 stock and a year later it's worth $1,100. Your nominal return is $100, or in percentage wise, 10%. Now, if that same stock also paid a $20 dividend during the year, your total gain is $120, or a total return of 12%. However, nominal return compared to real return is very different. Your nominal return doesn't tell the whole story. It doesn't account for inflation, which is why we use real return. Now, obviously, real return is adjusted for inflation. It adjusts your gain to, for the effect of inflation. If prices in the economy have risen 3% over the same year, your actual purchasing power only increased by 9%, not 12%. So let's say your $120 profit for the year's 12% gain. Well, technically, with 3% inflation increase, your real gain is $90, not $120, because we're going to cut down to 9%. And inflation quietly erodes the value of money and therefore the true return. It's also important to include all components of a return. So you got capital appreciation, which is the increase in price of the asset. You got income, such as dividends from stocks or interest in bonds. And when both are combined, you get the total return, which is the last term. And the total return gives you the most complete picture of how your investment has performed. And so measuring return the right way always helps you compare investments fairly, assess performance more accurately, and plan for real. Now, one of the most fundamental principles in investing is risk return trade off. So to simply kind of put it out there, if you want the potential for higher returns, you must be willing to accept higher risk. And if you want to minimize risk, you often need to accept lower return change. This trade off is true across almost all asset classes. For example, let's say a savings account has a very, very low risk. Your money is protected, but the interest you earn is minimal, right? You're protected, you are very like it's so unlikely for you to lose that money, but you're also getting a slight little interest, which is kind of like that like very little return. So you get low risk, but also very low return. On the other hand, stocks can have high returns, but they also come with the risk of short-term losses, especially during market downturns. This is where you get the high risk, high reward. And obviously, like I mentioned before, there is no such thing as a high return investment with risk. And if someone offers you that, it's a flag. And so the goal isn't to eliminate risk altogether. Instead, you want to take on the right level of risk for your financial goals on your level. Sorry, and your comfort level, right? So some investors are more aggressive and they're comfortable with volatility because they want long growth. Therefore, I'm gonna give you an example. Long-term growth, you want to make high risk, high return. You probably could be trading futures. You know, it's very, very volatile. If you buy a couple contracts in just a second, you could be down $1,000. You could also be up $1,000, right? It's very high risk, high reward. And others prefer stability and sleep better knowing their investments are more secure, even if their growth is slower. This could be a person who's not trading futures every day, but is simply putting a certain portion of their income into an index or a ETF and is just gaining that like 2% growth. And so what this creates is it creates a balance between risk and return and is what makes investment strategy personal. It depends on your goals, your time horizon, and your risk tolerance. That's why when someone's telling you to buy this stock or do this, you can't always just listen to them. You gotta like analyze your own risk and return trade-off and see what makes you comfortable and what your risk, obviously. So it's also this is kind of like off topic. Understanding risk isn't just about knowing this. We need to measure it. And one of the most important ways to measure risk is volatility. Now I use the word volatility a lot, but it's basically just how much something jumps down. It's how much it fluctuates. And in investing, I'm gonna say it again. Volatility refers to how much the value of an investment or return moves up and down over time. You could think of it like this: if an investment price is swinging wildly every day, jumping 5% up, then 3% down, it's highly volatile, right? High volatile is going up and down a lot. However, if the price moves steadily, like let's say maybe 1% or even less, that's very, very low vol. Why does this matter? Well, because volatility reflects uncertainty. The more volatile an investment is, the more unpredictable it becomes. And for a lot of investors, that unpredictability feels like risk. But volatility isn't just a feeling. We can actually measure it using a component called the standard. Standard deviation tells us how far an investment returns tends to stay from the average time. So let's break it down. Imagine an investment has an average return of 8%, right? If most years the return is close to 8%, say let's say I don't know 7 and 9%, then a standard deviation is low. This is because the difference between the average return and how much it actually returned is very, very small. So we're saying every year where there's like an 8% return. But let's say 1 year it's 9% return and next year it's 7% return. Well, that is a very, very small difference between the actual average and how much it happened, right? 1% up and down. That creates a very, very small. But if the investment return bounds between 5 to 12 to 3 and then 18%, even though the average is still 8%, then the standard deviation is higher because the difference from the average and all the actual prices is high, right? One time, let's go from 18%, that's a 10% gain. But then the next month from 8, it's 3, that's 5%. Or like it's very jumpy. The difference between the average and how much it actually is very, very high or low. Sorry, very, very high. When you have a lower difference between the average and the actual one, that's the low standard deviation. Very, very high. In this case, 18, 12, 3, 5 from the average. That creates a very high deviation. So to quickly summarize, low standard deviation is more consistent and a steady return, while higher standard deviation, greater ups and downs. And you may wonder, well, why does this matter? Well, because you can use standard deviation to compare the riskiness of two investments that offer similar average returns. You could also align your investments with comfort level for short volatility, and you could build a portfolio that's more risk efficient, meaning you get the most return for the least amount of fluctuation. And so it's important to remember that standard deviation doesn't tell you the direction of returns, it only gives you the right. An investment can have high standard deviation whether it's producing high positive gains or volatile losses. So while it's not perfect, standard deviation does give us a quantifiable kind of evaluate risk and is a key input for many portfolio strategies. One of the smartest ways to manage risk in your portfolio is also through diversification. I've talked a lot about this in stocks and even a bit in bonds. Diversification means not putting all your eggs in one basket. Instead, you spread your investments across different types of assets regions. And so you may wonder, well, why does this help? Well, because not all your investments move in the direction at the time. One asset is down, another might be up, helping balance out on returns, right? You could still be down, but not as much as if you stock or bond that went down. Let's say you invest only in one tech stock. That company has a bad quarter, well, your investment could drop significantly. But if you also own energy stocks, healthcare companies, bonds, and international ETFs, a loss in one area might be offset by gains in another, right? You could be 5% down in the tech market, but let's say energy, healthcare, your bonds are all up a lot. Well, that percentage that down actually might not even be down, right? Because if you add up all the percentages, you actually might still be up, but just a little less. But if you were just holding that one stock that is down, you are down money. And so this approach helps reduce what's called unsystematic risk. And it's the kind of risk that comes from individual companies or specific sectors. While you can't eliminate systematic risk, like a global recession, right? Because systematic risks affects everybody, you can generally reduce company-specific, sector-specific diversification. If you want to try to eliminate unsystematic risk, systematic risk, nobody's in control. This is like the government, high interest, like all that stuff, like something you can't control. And so the goal isn't to avoid risk altogether, it's to build a portfolio that's more stable and consistent over time. Diversification helps smooth out the ups and downs, especially in a volatile market. It's also the foundation of strategies like the 60-40 split portfolio, where 60% is invested in stocks for growth, and then you have 40% for 40% of bonds for stability, or like modern asset mix that include like. So to summarize, a well-diversified portfolio tends to perform more steadily across different market environments, helping you stay invested with more confidence and stress. Now, for the last thing, we're going to talk about risk tolerance. So now that we've talked about like different types of risks and how you measure it and how to manage it, it's important. It's time to ask an important question: how much risk can you personally? That's why it's called risk tolerance, and it's different for everybody. You gotta understand that risk tolerance is different for everyone on their financials, how much they can afford to lose, and it's different. So your risk tolerance is shaped by both emotional and financial factors. For example, let me give you an example. How comfortable are you with seeing your investment drop in value, even temporarily? Or do you lose sleep during market downturns? Or are you unfazed with short? How soon will you need the money you're investing? Right? These are different questions you can ask. If you're investing for retirement 30 years from now, you could typically afford to take more risk because time gives your portfolio a chance to recover losses. But if you need the money in just a few years, let's say for a home purchase, you may want to play it safer, right? You want to play it safer. Income level, job stability, debt, and even life stage also affect your ability to losses. A 25-year-old tech worker with low expenses may be more aggressive than a 60-year-old approaching retirement. And there's more psychological side to it. Some people just aren't comfortable with volatility, no matter what the math say, whatever the math says, and that's okay because investing should match both your goals and your temperament. And so, what is the key takeaway? Well, there's no perfect level of risk, only the level that fits. The best investment strategy is the one you can stick with